listen to me very carefully, because I'm only going to say this once, and what I am about to tell you could be the single most important financial conversation you have ever had in your entire miserable paycheck to paycheck life. Right now, as you're sitting there watching this video, your employer is getting rich off your labor, your bank is getting rich off your savings, your government is getting rich off your taxes, and you are getting poorer every single day. You do nothing about it. I am Robert Kiyosaki. I wrote Rich Dad, Poor Dad, the best-selling personal finance book in history, and I have spent decades watching good, hardworking people get absolutely destroyed financially because nobody told them the truth. Well, I am telling you the truth right now. Stop what you are doing. Put the phone down, sit up straight, because today I am going to show you exactly how to buy 5 categories of ETFs that will replace your salary and put money in your pocket while you sleep, while you eat, while you breathe, without ever clocking in again. If that sounds like something you actually want in your life, then stop being stupid and hit that subscribe button right now. This channel is where I come to deliver the kind of financial intelligence that Wall Street does not want you to have. The advice on this channel is worth thousands of dollars in consulting fees, and I am giving it to you completely free. The only price you pay is a subscription and your commitment to stop thinking like a poor person. Subscribe now. Do it before you watch another second of this video, because people who refuse to invest even 10 seconds into their own financial education are exactly the kind of people who die broke. Here is the cold, hard reality that your school never taught you, that your parents never taught you, and that your employer absolutely does not want you to figure out. Your paycheck is not income. Your paycheck is a leash. Every single morning when you wake up and drag yourself to a job you probably do not even love, you are making a trade. You are selling your time, your energy, your health, and your best years in exchange for a fixed number that someone else decided you are worth. And that number, no matter how hard you work, no matter how many extra hours you put in, is always going to be capped. Your boss has a ceiling on what he will pay you, and that ceiling is always lower than what your labor is actually generating for the company. And that is the definition of financial slavery, and most of you are living in it right now and calling it a career. I do not say this to hurt your feelings. I do not care about your feelings. I care about your money. The problem is not that you are lazy. Many of you work incredibly hard. The problem is that you have been programmed, deliberately, systematically programmed, to work for money instead of making money work for you. Your poor dad, just like mine, told you to go to school, get good grades, find a safe job, and save your money. And what happened? You followed that advice, you went to school, you got the job, and now you are saving your money in a bank account that is paying you 1% interest while inflation is eating your purchasing power alive. Cash is trash. Every dollar sitting in your savings account is a dollar that is slowly dying. The numbers do not lie, and the number on your bank statement is lying to you about your future security. Now, before I show you the 5 ETF weapons you are going to use to escape the paycheck trap, I need to destroy one of the most dangerous myths in personal finance, because this myth has killed more financial futures than any stock market crash in history. The myth is this, that if you want dividend income, you should go out and find the highest dividend-paying stocks you can find, dump your money in, and sit back and collect the checks. That is not a strategy. That is gambling dressed up in a suit. I have watched people fall for this trap over and over again. They go on the internet. They search for the highest yielding dividend stocks. They find some fund paying out 12, 15, even 20% annually, and their eyes light up like a kid on Christmas morning. They put their money in, and for a few months, everything looks beautiful. Then the dividend starts to shrink, then the stock price starts to collapse, and then one morning they wake up and the company has cut the dividend entirely and their investment is worth half of what they paid for it. You want to know why that happens? It happens because they were not investing in a strong company. They were chasing a yield number without understanding what was underneath it. A high dividend that is not supported by real growing profits is not a gift. It is a warning sign. It is the financial equivalent of a company waving a white flag and saying, we have nothing left to reinvest in our own growth. So here, take this cash before we go under. That is not the kind of dividend you want. The kind of dividend you want is the kind that is boring at first. Maybe 3 or 4%, but is backed by a company or a fund with real earnings growth, real profit margins, and a track record of increasing that payout year after year after year. Because when a company grows its profits and grows its dividend consistently for a decade, that is not luck, that is discipline, that is quality, and that is the foundation upon which you are going to build your financial freedom. Now let me give you the mathematics of why this actually works, because the numbers are where most people either wake up or fall back asleep. Pay attention, because I'm only going to walk you through this once. Let us say you invest $1,000 every single month. You do that for 30 years. If you put that money into a savings account earning essentially nothing, you end up with $360,000 and zero passive income, zero. You worked 30 years of consistent saving and you have nothing generating income for you. That is what your bank wants. Now, let us say you wake up slightly and you invest that same $1,000 a month into a growth-focused portfolio earning the average 8% per year return. After 30 years, your portfolio is worth approximately $1.5 million. That sounds impressive until you realize that $1.5 million in an account produces no income unless you start selling pieces of it. The moment you start selling, you start shrinking. And the moment you start shrinking, you start dying financially. But now let us talk about what happens when you combine that same 8% growth rate with a 4% annual dividend yield. Suddenly you have that same $1.5 million portfolio, but now it is generating $5,000 every single month in passive dividend income. You did not sell a single share. You did not clock in a single hour. That money arrived in your brokerage account because you owned assets that paid you, and it will keep arriving next month and the month after that as long as you hold those assets. But here is where the real wealth is built. And this is the concept that separates the financially free from the financially enslaved. It is called DRIP, Dividend Reinvestment Plan. Instead of spending those $5,000 monthly dividends, you take every single dollar and you reinvest it back into buying more shares of the same dividend-paying fund. You're using your income to buy more income-producing assets. You are letting compound interest do the work that you used to do with your body. And after 30 years of doing this, 30 years of investing $1,000 a month, earning 8% growth, collecting a 4% dividend, and reinvesting every penny, your portfolio is not worth $1.5 million, it is worth over $3.1 million, and you are not generating $5,000 a month. You are generating $11,700 a month every single month passively. The numbers do not lie. Compound interest combined with dividend reinvestment is the closest thing to a legal money printing machine that exists in this world, and most of you are not using it because you were never taught how. Now let us get specific. Let us talk about the 5 categories of ETFs that are going to become your financial weapons. These are not tips. These are not suggestions. These are the instruments of your liberation, and I want you to treat them with the seriousness they deserve. The first category is your foundation. These are the core United States dividend growth funds, companies that are deeply embedded in the American economy, generating real profits and committed to growing the amount of cash they pay their shareholders every single year. The first instrument in this category is SHD, the Schwab U.S. Dividend Equity ETF. This is one of the funds I consider to be among the most disciplined in the entire dividend space. It does not chase the highest yield. It focuses on companies with strong fundamentals that have a proven commitment to growing their dividends. At the time this was recorded, SHD was paying out approximately 3.4% annually in dividends, and over the last 10 years, it has grown that dividend by an average of 10.6% per year. Think about what that means. If you are earning 10.6% more in dividend income every single year, your passive income is more than doubling roughly every 7 years without you adding a single additional dollar. That is the power of dividend growth investing. And SCHD is one of the cleanest expressions of it, available to the average investor today. The second instrument in this category is DGRO, the iShares Core Dividend Growth ETF. This fund casts a slightly wider net than SHD, requiring companies to have grown their dividend for at least the last 5 years rather than 10. That makes it a bit more inclusive, a bit more diversified, and it currently yields around 2.4% annually with a 10-year average dividend growth rate of approximately 8.6%. Then there is VIG, the Vanguard Dividend Appreciation ETF, which focuses on companies that have increased their dividend every year for at least the last decade. It carries a lower current yield of around 1.5%, but its 10-year average dividend growth rate of 7.7% reflects the deep quality of the companies held inside it. And finally, in this category, there is VIM, the Vanguard High Dividend Yield ETF, which tilts in more toward current income, paying around 2.3% annually with dividend growth of approximately 6.5% per year. This is your foundational arsenal. If you do nothing else, if you never touch another category in this video, building a consistent position in these core United States dividend growth ETFs over decades will put you in a financially superior position to 90% of the working population. The second category is international exposure. And let me tell you something that most American investors are too arrogant or too ignorant to acknowledge. The United States is not the only country on earth that contains excellent, profitable, dividend-paying companies. Some of the most cash-generative businesses in the world are sitting in Europe, Asia, and emerging markets, and they are paying out dividends that put many American companies to shame. The first international weapon is BYI, the Vanguard International High Dividend Yield ETF. This fund is entirely focused outside of the United States, targeting the highest dividend-paying companies internationally. It currently yields around 3.5% annually and has grown its dividend at approximately 8% per year over roughly the last 8 years of available data. The second international option is SQIMANGE, the Schwab International Dividend Equity ETF. This is a newer fund with a shorter track record, but it is currently yielding around 2.3% with a dividend growth rate of approximately 8.28% annually. The reason you want international exposure in your dividend portfolio is not just about chasing higher yields. It is about diversification. It is about ensuring that your passive income stream is not entirely dependent on the health of one single economy. When the American economy stumbles, and it will stumble, because every economy stumbles, your international holdings will provide a buffer that keeps your dividend income flowing, while your neighbors are panicking and selling at the bottom. The third category is where I personally find some of the most compelling evidence that quality and consistency pay off over time, and that is the Dividend Aristocrat funds. A Dividend Aristocrat is a company that has not merely paid a dividend, but has actively increased its dividend every single year for at least 25 consecutive years. 25 years. Think about everything that happened in the last 25 years. The dot-com crash, the September 11th attacks, the 2008 financial crisis, the COVID pandemic, multiple recessions, currency crises, geopolitical upheaval, and these companies kept raising their dividends through all of it. That is not luck. That is fortress-level financial discipline, and that is exactly the kind of company you want paying you income for the rest of your life. The first Aristocrat ETF to consider is NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. This fund specifically targets companies that are both members of the S&P 500 and have increased their dividend every year for the last 25 years minimum. It currently yields around 2.3% annually and has grown its CROT dividend by approximately 8.5% per year over the last decade. The alternative here is DGRW, the Wisdom Tree U.S. Quality Dividend Growth Fund, which is focused on United States companies demonstrating both dividend growth and quality earnings characteristics. Its current yield is lower at approximately 1.3%, but its 10-year average dividend growth rate of around 13% annually is one of the highest in the entire dividend ETF universe. 13% average annual dividend growth means your income is compounding at a ferocious rate. And that is what creates life-changing generational wealth over a 30-year investment horizon. The fourth category is one that most retail investors completely overlook because they are too busy chasing the big tech names they read about in the news. This is the mid-cap dividend category. Mid-cap companies are businesses valued between approximately $2 billion and $10 billion. They are not startups, they are not experiments, they are established operating businesses with real revenues, real profits, and real dividends. But unlike the Apple-sized giants of the world, they still have meaningful room to grow, which means their dividend growth potential is often significantly higher than their larger counterparts. The first mid-cap weapon is RAGL, the ProShares S&P Mid-Cap 400 Dividend Aristocrats ETF. This fund applies the aristocrat standard to the mid-cap universe, targeting companies that have increased their dividend every year for at least 15 consecutive years. It currently yields around 2.4% annually and has grown its dividend by an impressive 11.6% per year over the last 10 years. Then there is PE, the Invesco High Yield Equity Dividend Achievers ETF, which focuses not only on companies that have consistently raised their dividends, but also on those with improving stock price momentum, indicating both income growth and capital appreciation potential. PEY currently yields approximately 4% annually, with a 10-year average dividend growth rate of around 8.1%. And for those who want broader mid-cap exposure without the strict aristocrat filter, there is DMDV, the Wisdom Tree US Mid-Cap Dividend ETF, currently yielding around 3% annually, with a 10-year average dividend growth rate of approximately 5.9%. The mid-cap category is where patient, disciplined investors harvest returns that the average investor never even thinks to look for. Now we arrive at the fifth category, and I want to be very direct with you about what this is and what it is not. This is the covered call ETF category, and it is the highest risk category I am going to discuss today. I am not telling you to avoid it. I am telling you to understand it before you touch it. Covered call ETFs work by holding a portfolio of stocks and simultaneously selling options contracts called covered calls. On those same stocks, the premiums collected from selling those options are what generate the income, which is then paid out to you as a distribution. The result is a significantly higher current income yield than traditional dividend funds. The downside is that in a bull market, your upside is capped because the options buyers have the right to purchase your shares at a predetermined price, limiting how much you benefit from strong market gains. Additionally, unlike the dividend aristocrat funds, covered call ETFs do not have the same track record of growing distributions over time. They are an income today vehicle, not an income compounding vehicle. The first example here is JEPIT, the JP Morgan Equity Premium Income ETF, which holds S&P 500 companies and generates premium income through its options strategy, having paid out approximately 8.2% over the last 12 months. The second is JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, which applies the same strategy to Nasdaq-focused holdings and has paid out approximately 10.5% over the last 12 months. If you are going to use covered call ETFs, use them as a component of a larger strategy, not as the foundation of your entire dividend portfolio. Use the aristocrat funds and the core dividend growth funds as your bedrock, and use covered call ETFs as the higher octane supplement for accelerating near-term income. That is how you use these tools intelligently rather than recklessly. Now let me give you the single most important operational principle for making all of this work, because the best ETFs in the world are completely useless without the right behavior behind them. I call it ABB. Always be buying, not sometimes, not when the market feels good, not when your friends are excited about stocks. Always, every month, regardless of what the headlines say, regardless of what the market is doing, regardless of what the Federal Reserve is or is not doing, you invest your money consistently into your dividend ETF positions. You invest when markets are up. You invest when markets are down. You invest when markets are sideways and boring and nobody is talking about them. And here is the critical point that separates the winners from the losers in this game. When the market crashes, you do not sell, you buy more aggressively. I'm telling you this because the single greatest destroyer of long-term dividend wealth is not a bad ETF selection. It is panic selling. Every major market crash in history has been followed by a recovery, and every investor who sold at the bottom locked in their losses permanently, while the patient investors who kept buying accumulated more shares at dramatically lower prices, setting themselves up for explosive dividend income growth on the other side of the recovery. Stop being a victim of market volatility. Start being a predator who uses it. The crash is not your enemy. The crash is your discount sale. Every time the market drops 20%, your monthly investment buys 20% more shares, which means 20% more dividend income in your future. That is not a crisis. That is an opportunity, and only the financially educated know how to see it that way. Let me close with this, and I want you to hear every word you came to this video today, because something in your life is not working. Maybe you hate your job. Maybe you are scared about retirement. Maybe you watched your parents work their entire lives and end up with nothing, and you swore to yourself that would never be you. Good. Hold on to that feeling, because that feeling is your fuel. But feeling is not enough. Awareness is not enough. You can watch 1,000 financial videos and be completely broke at 65 if you never take action. So here is the question I am putting directly to you right now. Are you going to be a winner or a loser? A winner takes this information, opens a brokerage account today, sets up a monthly automatic investment into one or more of these ETF categories, activates their DRIP, and commits to the ABB strategy for the next decade, the next 2 decades, the next 3 decades, regardless of what happens in the market. A loser watches this video, feels inspired for 20 minutes, closes the app, and does exactly what they did yesterday. The choice is yours and only yours. The market does not care about your excuses. The compound interest does not care about your circumstances. The numbers do not lie. They never have. They never will. Your salary can be replaced. Your financial freedom is achievable, but it requires you to stop being a consumer and start being an investor, starting today, not tomorrow, not next month, right now.